We're back, and it's time for Ask Annex. It's annexwealth.com. Look for the Ask tab. Matt Morzy is Director of Research, CFP at Annex Wealth Management. Welcome.
Hello, sir.
Here's Fred Coleman, CFP and a Wealth Manager. Welcome to you.
Hey, Danny.
Question 1 on Ask Annex. Actually, it's 2. I need to combine these. First is, I don't want to start chasing returns, but my high-yield savings account return keeps heading down. Is it time for something like a very short-term Treasury bond ETF? Second question from somebody else. If inflation rises again, cash yields will rise. Sounds like my high-yield savings account is still a decent place to stash cash. Opinions, guys.
Yeah, it's interesting. Both questions kind of hit it from a different angle or opposite angle. What I would say is, first of all, shop around. See what else is out there. You want to make sure that whatever rate you're getting on your high-yield savings account is attractive and comparable, because every bank, every place is going to have a different rate. Some of them are much higher than others. Some of them are lower. A lot of those major banks have not increased rates to the same extent than some of the smaller ones are, so I would certainly look at that. You also want to look at custodial money markets, and then look at the short-term Treasury ETFs or Treasuries themselves, depending on how far out you want to go, or the dollar amount. What I would say overall is that, I think everybody's assumption last year was that the Fed was going to start cutting rates, and then they were going to keep doing it, and rates were to come back down to 3% or lower. And now, due to where inflation's at and potential, increases in inflation this year, at least some people are worried about that, the Fed just paused, and I think we're likely to see some more pauses coming up. So the cutting is probably not to the extent that many people thought. So rates should stay relatively elevated to around where they are. So there's probably not a lot of fear that your rate's going to go down. But if it is, I would certainly shop around and look for something else. Because if it's going down, there's other places that are not. And I would say the fear that's going to go down too much is probably overblown there. But I would shop around and take a look. Right now, as of recording this, if you're getting over 4%, I think that's probably a good rate, and you're probably okay there. But I would look for something like that.
Yeah, I would agree with that, Matt. Sometimes it just takes a simple call to the bank or call to the custodian, and, you could, increase your rate by a couple percentage points, or, you may be in something that's not actually the highest yielding opportunity. The other thing to keep in mind with this short-term money, it is short-term money. So whatever you can get out of it, great. But there's been situations, especially if it's an emergency fund, where for the longest we weren't getting anything out of it, right? So just reevaluating your goals. Is this money that you actually need in cash for the short term? Then great, get the highest rate. If not, then maybe you should look for a separate investment option.
When we hear about interest rates rising and falling, they're usually talking about the Fed.
Mm-hmm.
Cash is not tied to that, though, right?
It's related. So the Fed is going to change essentially what the rate that's borrowed between different other banks are. So that's what they're controlling of, and a lot of times that is going to cause other rates to move as a response to that. Generally, on the shorter end of the curve is where they're going to have a little bit more control on how that works, and that's why the high yield savings account or short-term treasuries are going to have the most impact. But also keep in mind that if you have something like a treasury, it's going to move inverse to the change in yields. So if yields are moving up, your treasury is probably going to move down as a response. And so there's a little bit of a wiggle room there on that too, just to watch out for if you are going to use something like that.
He had to bring math into it, didn't he?
He lost me with the math.
It's Ask Annex. Next question. My former employer might be closing its pension plan. Is it better to claim the annuity or a lump sum? Is that it depends?
It's always it depends on your particular situation, right? And that's where I'm going to go with this. But the important thing to know is that it's not a standalone decision. So you don't just look at the numbers and say, will I get more out of the annuity or more out of the lump sum? That's one way to look at it. But you also have to look at how it fits into your financial plan. What are your other income sources? What are your other investments that you have? Taxes. What is your health like? Because if you pass and you take the annuity option, does that stop? Maybe it continues on to a survivor. Do you need it to continue on to a survivor? So those are all questions that you should ask yourself. Now, when it comes to the lump sum option, if done correctly, you're able to defer taxes on that lump sum. And then you also have the option to invest that lump sum. That way, that lump sum is going to be in your family, regardless of whether you pass or not. And it gives you a little bit more flexibility. So Again, back to your sentiment, Danny, is it does depend, but most of the time I've seen the lump sum be a little bit more done effectively if used the right way.
And this is the way we think. This is the way we plan. If you're a client of Annex Wealth Management, these are the things we do.
Yeah, absolutely. Anytime a client has an annuity, we do a full analysis of that. And again, that's not a standalone thing. It works into your financial plan.
Fred Coleman's a CFP, Wealth Manager at Annex Wealth Management. Thanks.
Thanks, Danny.
Matt Morzy, Director of Research, also a CFP. Thanks.
Thank you.